Nigerian lender Unity Bank PLC has denied entering a binding agreement with private equity firm Milost Global Incorporated over a potential $1 billion investment, saying talks were only preliminary and didn't come with any commitments. New York-based Milost this week said it terminated talks to provide debt and equity funding to Unity, saying it received threats that it will be run out of the country if the deal continues. The firm said a term sheet was signed in September and approved by the board of Unity, which needed the capital to strengthen its balance sheet and to expand. Milost said it will ultimately have acquired 60% in the Lagos-based bank. However, on Thursday, Milost stood by its views that the bank had breached an agreement. Milost Chief Executive Officer Kim Freeman has called for Nigeria's Securities and Exchange Commission and the country's stock exchange to investigate the matter. Now, the U.S. plans to suspend duty-free access to Rwandan textile imports because of the African nation's refusal to lower trade barriers for American-made clothing and shoes. The suspension applies to all AGOA-eligible apparel products from Rwanda in 60 days. The USTR last year began an out-of-cycle review to determine the eligibility of Rwanda, Tanzania, and Uganda to keep their trade benefits under the African Growth and Opportunity Act, which was signed into law by President Bill Clinton in 2000. Rwanda's African nations that undertake economic and governance reforms with duty-free U.S. market access. The USTR's review was in response to a complaint by the U.S. textile industry over a decision by the 3 East African nations to ban imports of used clothing and shoes they say are disseminating local textile and apparel industries. The U.S. exported $330,000 worth of textiles and apparel to Rwanda in 2016 and imported about $460,000 coffee and tea shipments, where Rwanda's a top U.S. export worth $18 million. And South African retailer MASSMART is ramping up its Pan-African expansion strategy with plans to open around 20 new stores across the continent over the next 3 years. MASSMART, majority owned by U.S. retail giant Walmart, already operates nearly 400 stores, including 42 across 12 countries outside South Africa.
South African retailer MASSMART is continuing its Pan-African expansion with plans to open about 20 new stores outside its home market over the next 3 years. MASSMART, majority owned by U.S. retail giant Walmart, sells everything from food and televisions to refrigerators and operates nearly 400 stores, including 42 across 12 countries outside South Africa. Koseni Dlamini spoke to the media on the sidelines of the African CEO Forum in Ivory Coast's commercial capital, Abidjan.
We're very bullish about Africa. Our focus is Africa, sub-Saharan Africa as a whole. We see medium to long-term prospects. That's why we've got very ambitious expansion and growth plans on the African continent. We currently have 42 stores across 28 cities in 12 countries across Africa. And this year alone, we'll be opening 8 additional stores on the African continent. And in the next 3 years, we'll be increasing our retail space, our trading space by 35.6%, which to us is really exciting.
New stores are due to open in Kenya, Ghana, Mozambique, Zambia and Swaziland. Dlamini says MASSMART is also studying markets in French-speaking West and Central Africa with a view to starting operations there.
We see long-term prospects on the African continent, the trend towards urbanization, rising middle classes, industrialization, whether you're talking about traditional industries or the fourth industrial revolution that we're talking about here. Really, these are all forces that are auguring well for the emergence of a consumer class that needs to be serviced.
South African retailers have struggled as consumers battling job losses and high personal debt levels hold back on spending. shares in MASSMART, which posted a 2% rise in annual profits in 2017, have failed to keep pace with ShopRite, Africa's biggest retailer, which has pursued an aggressive expansion strategy abroad as the economy at home has lagged. South Africa slipped into its first recession in 8 years in 2017, with political turmoil sending business and consumer sentiment to multi-year lows.
Still in South Africa, a court has dismissed a bid to block $4.7 billion in renewable power contracts, removing an obstacle to the first major investment deal under President Cyril Ramaphosa. The last-minute legal challenge was launched earlier this month by the National Union of Metal Workers and Transform RSA, a group which has lobbied for ousted President Jacob Zuma in the past. It was opposed by the Energy Ministry and State Power Utility ESCOM, which had been due to sign 27 mostly wind and solar deals with independent power producers. On Thursday, the court in Pretoria said NUMSA and Transform RSA's legal application was not urgent and should be set aside. International mining firms, including Glencore and Randgold, on Thursday proposed a sliding scale for royalty rates on key commodities mined in Democratic Republic of Congo as an alternative to a windfall tax. A new mining code that increases taxes and royalties of miners of commodities, including copper and cobalt, was signed into law in early March despite industry opposition. Cobalt, whose price has quadrupled in 2 years, is one of the metals used to make batteries for electric vehicles, and more than 50% of the world's reserves are in Congo. The mining industry said in a statement that the sliding scale, whereby royalties due to the government move in line with the commodity price, would give Congo an immediately higher share of revenues at current prices than what the new code stipulates. Still in Congo, Airports de Congo, a unit of Groupe AGs of France, has threatened to halt operations at 3 airports it manages because of debts owed by the government. The state owes the company 5 billion CFA francs, that's about $9 million, including value-added tax refunds and landing fees. The company is unable to pay its own bills for water, electricity and security because of the debt. ARCO operates 3 airports in Brazzaville, the port city of Pointe-Noire and Olombo. And Namibian economy contracted by 1% in the 4th quarter of last year versus a reversed contraction of 1% in the 3rd quarter. That's according to data from the Statistics Office. Gross domestic product contracted by 0.8% in 2017 compared to growth of 0.7% in 2016. And finally, Botswana's economy expanded 5.5% quarter-on-quarter in the last quarter of 2017, following a 1% contraction in the previous 3 months. On an annual basis, gross domestic product grew by 6.5% after expanding by 1.1% in the preceding quarter. Botswana's economy is projected to expand at a faster pace in 2018 compared to last year, as the mining sector is benefiting from a recovery in the global economy. And that's a wrap on the program for today and, of course, for the week. Thank you very much for watching. I'm Chimize Obi Uwago.